Hi, we are the CQA team from the Owen Graduate School of Management at Vanderbilt University. We are students in the Master of Science in Finance program, and we possess diverse educational and cultural backgrounds, including two engineering majors, an accounting and economics, and a business major. Our mentors for this challenge are Bola Olusanya, Managing Director at Strategic Investment Group, where he oversees the firm's US equity portfolios and conducts due diligence. He previously worked at Vanderbilt University's investment office and currently serves on the advisory board of the Owen School of Management MSF program. Bob Whaley is the Blair Potter Professor of Management at Vanderbilt University. His past teaching positions include Duke University, the University of Chicago, and the University of Alberta. He is well known in the field of finance for the creation of the Volatility Index and other important contributions.
We started with a multi-factor quantitative strategy and then overlaid it with a qualitative one, which gave us the flexibility we felt we needed. Our quantitative investment thesis consisted of four main equally weighted factors: valuation, quality, growth, and momentum. For valuation, we focused on relative value, looking at actual valuation cross-sectionally and sector relative ranking within the GIC sectors. We measured quality by looking at accruals, return on equity, and investment capital, creating a composite which measures overall quality. For our momentum factor, we used price and earnings momentum and leaned on analyst estimates for the latter. Our qualitative investment thesis consisted of market sector, macroeconomic, and company-specific bets. Right now, the markets are being driven by a familiar array of concerns. Oil prices, having dropped over 50% from 2015 highs, also plunged for most of January. Additionally, China's stock market rout continues, bringing fresh concerns about the impact of a slowing Chinese economy on the rest of the world. Our market sector bet was mainly on a rising interest rate environment and has not helped given the current market. Similarly, we were long oil, thinking that a reversion to the mean was imminent. We also went long JCPenney and Square briefly and took haircuts getting out of those positions. Looking back at our performance, we should have stuck to our quant strategy, but hindsight's always 20/20.
Here's a look at the process we employed to create our model and build our portfolio. We began by developing our overall strategy, including the qualitative and quantitative aspects that Ben just discussed. Then we generated our equity factors within the market software. Using this software, we ran through a number of different models in order to choose our optimal model that we will discuss more in depth in a little bit. Once the optimal model was determined, we bought and sold our stock positions within StockTrack. And then once our initial portfolio was created, we periodically tested and rebalanced our model in order to continually advance and improve our portfolio. After we developed our strategy, we then needed to build our model. Using the market software and the four main factors we discussed earlier, we created a number of different models. To determine what the best model was, we looked at the returns and standard deviation in order to maximize our Sharpe ratio. Based on this optimization, our final model included 2 value factors, 2 quality factors, a growth factor, and 2 momentum factors. For value, we had a deep value factor, specifically leading 12-month EBITDA to enterprise value, and a relative value factor, which was industry relative trailing 12-month sales to price. The 2 quality factors were earnings quality, which was the earnings response coefficient, and management quality, where we used free cash flow return on invested capital. For growth, we used a historical growth factor of 3-year change in assets adjusted trailing 12-month earnings per share. The last 2 factors were our momentum factors. We included an earnings momentum factor, which was the 3-month revision in earnings per share forecast, and a price momentum factor, which was the 24-month value at risk. We equally weighted each of the 7 factors I just listed based on our input from our advisor. Out of the stocks that the model gave us, we went long on the top 50 performers of our model and short for the bottom 50 performers. A large part of this challenge is staying within given guidelines and complying with the rules that CQA set forth. This affected our model in a number of different ways. We were given a certain universe of stocks to use, and because of this, some of our top and bottom performers couldn't be used when we were choosing our positions. Another factor was the neutral beta. We had a difficult time creating a portfolio from our list of stocks that gave us a beta within plus or minus 0.5 points. The other guidelines included a maximum position size, which was an initial investment of 5% of the unlevered portfolio, a maximum cash balance, which had to be less than 5% of our total portfolio, and being dollar neutral, which meant staying within plus or minus 5% of our net market value. With how diversified our portfolio was, we were never able to take advantage of big sector upswings. You can see from this chart that our portfolio very closely matched the performance of the market. And as the S&P declined, so did our portfolio. From the chart of our performance, we could see that we began to decline faster than the market, and so we decided that we needed to recalibrate our model. We realized a few issues with our model that we needed to redesign for the next one. We needed to include a risk factor in order to account for volatility of the stocks. We also overestimated the comeback of the energy sector. We were trying to be market timers with the energy sector, but mistimed the rise, or lack thereof. The last problem was that we didn't lock in our gains soon enough. Waiting too long to close out our best positions cost us as the market slid further downward. Based on these issues, we came up with a newly calibrated model.
A few weeks ago, we realized that a lot of our stock positions were likely not going to rebound, and our periodic recalibration was overdue. In order to lock in our current gains while also ridding our portfolio of toxic equities, we decided to change up our equity model factors. Being further behind in the competition than most teams led us to devise our scheme around maximizing return at the expense of risk management. Basically, we had to go for broke. Our qualitative analysis centered around the hypothesis that in these uncertain financial times, blue chip stocks with historically low volatility would be leaned on heavily by risk-averse investors. We made a few updates to our multi-factor equity model to better capture this thesis and to generate companies that fit our need for dramatic price appreciation. We use our model to buy large market cap companies with high notoriety and to short smaller companies. We don't currently have enough data to offer an opinion on the success of this strategy, but we remain eternally hopeful. One key takeaway that we use to inform this recalibration is that this financial market season between October and February has been extremely hard to predict. We took some lumps early on with making specific sector plays and with company stock picking. We realized that we should leave these types of assumptions to the professionals and to structure our portfolio with greater diversification and more macroeconomic bets. In summation, we learned a lot from this CQA investment challenge, and we're definitely going to continue to carry it forward in our financial careers.